get right to the top 3 things that you need to know at 9 a.m. Futures are in the red this morning after Fed Chair Jerome Powell squashed any hopes that a pivot or a rate cut is coming anytime soon.
It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike.
A big warning from Qualcomm. The chip maker slashed its forecast for smartphone shipments and provided a gloomy sales outlook, signaling a sharp turn in consumer demand.
And Roku shares are plunging after the company gave a weaker than anticipated outlook for the holiday quarter and warned economic conditions will degrade advertising budgets. But we begin today, of course, on the markets. Julie, let's get over to you on the day after the big Fed decision.
Yes, let's take a look at the S&P 500 yesterday because we want to see the reaction in real time as we were getting the press conference. Of course, as expected, the Fed raised interest rates by 75 basis points. We're going to get more from our Jen Schonberger in a moment. The language you just heard Powell use in the open about it being premature, that's when we saw stocks really start to tumble here. They had rallied on hopes that perhaps the language about the Fed continuing to be data dependent and having smaller rate hikes for the remainder of the year. That's what caused a little bit of a bump here, and then things just went rapidly south. This is something we've been hearing from a lot of people over the past few days, but we'll talk about that more in just a moment. Something else that we have to talk about here is what's going on in the rates market as well, with yields now at 4.20, folks. We haven't seen that in quite some time here, certainly not at all really this year for any sustained period. So that's something we continue to watch. And on the other side of the pond, the Bank of England this morning also raising interest rates. But contrary to what we're hearing here, the Bank of England said, no, we're not going to be raising rates anymore because we are too concerned, Brian Sozzi, about a recession. Very different tone.
Thank you, Professor Hyman. Fed Chair Jerome Powell striking a hawkish tone at the press conference yesterday, saying it's premature to think about pausing rate hikes. Take a listen.
Very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that.
Let's bring in Yahoo Finance Fed correspondent Jen Schonberger for more. Jen, lots of conflicting signals to investors off of that press conference.
Good morning, Brian. Yeah, that's right. Fed Chair Powell laying the table to begin slowing down the pace of rate hikes, but said that the question of when to moderate the size of future rate hikes isn't as important as how high the central bank ultimately raises interest rates to tame inflation. Powell says that interest rates will now rise higher than forecast. Take a listen.
Still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation.
All of this means the interest rate projections for ending rate hikes around that 4.6% level forecast back in September are too low. The question, how much higher do they go? Roberto Perrelli, a longtime Fed watcher over at Piper Sandler, says he thinks the peak rate could rise to 4.8% at minimum. We will get new interest rate projections in December. Now, Powell was extremely clear that a pause is not in sight, and so a pivot is not on the radar. For now, Powell and company say they will take into account the impact of cumulative rate hikes already done and the lag effect of monetary policy on the economy, inflation, and financial conditions. Now that the Fed has hiked 3.75 percentage points since June, Powell says the need for speed has become less important. Powell says officials will look to begin slowing the pace of rate hikes in the next few meetings, and will discuss that at their next meeting in December. Guys.
All right, Jen Schonberger, thanks so much for bringing that to us and continuing to break this down. Let's continue the conversation here, though, in the morning, because now as we think about the Fed's dual mandate, and you might even add the third of this moderate long-term interest rates, you combine that with price stability and employment here, we're going to get even more of that employment situation tomorrow. But when you think about that long-term view that Fed Chair Jay Powell was laying out, that may be more in line with what even Goldman Sachs was pointing out at the beginning of this week at around 4.75%, upwards to 5% by March.
Yeah, and check this one out, Brad. Just in, you look at Goldman Sachs' Jan Hatzius noting, we see the risk to our own peak funds rate forecast of 4.25% to 5%, as you mentioned, Brad, as tilted to the upside. A little bit of a language shift from the folks at Goldman Sachs, but I think captures why you're seeing futures under pressure, why you saw that big downdraft in markets. This is a market that does not want to see a hot labor report tomorrow.
At the same time, the hot labor report doesn't matter as much to the Fed. And yesterday kind of cemented, and Julian Emanuel over at Evercore ISI writing that this morning, he says, price stability above all. It's official. This is something we've talked about this year already, that the Fed, obviously, even though it has that dual mandate, is paying a lot more attention to price stability and to inflation than it is to the labor market. It's willing to put the labor market aside for now, even if it is hot. That doesn't seem to be changing the Fed's trajectory. But will it change the market trajectory? Because with that labor market hot, does it indicate that it's going to take longer for the feed through to inflation, right, and then for that to come down and for the Fed to react to that?
And it is the feed through, right? How much they are continuing to move forward with their policy and when they're actually seeing that show up in the data as well. And what Powell said yesterday, we need to see inflation coming down decisively. Good evidence of that would be a series of down monthly readings. It's a question of how far ahead of those monthly readings would the actual policy be put into place, and how kind of calm would they be about waiting for that data to come through as well?
Absolutely.
And by the way, Julian also says a retest of the lows is now the base case here, that we are going to go
investors
back
got ahead of themselves, thinking nowhere did the Fed say, I would argue, over the past 2 to 3 months, they were pivoting on anything. That has been the complete opposite of what they've been saying.
Absolutely.